Hello, everyone. Welcome to an Options Income Blueprint Options Income Weekly Live. It's February 6, 2023 at 11 a.m. Eastern. You're here with Michael Schulman, and my name is Emily Norris with Traders Reserve. Just to let you know, we are recording this session. We will be posting it to the member website as well as sending it out to you in your Options Income Weekly newsletter. If you have any questions throughout the session, just pop those in the Q&A box. We'll get to those once we've wrapped up with today's presentation, and we meet tomorrow for live trading at 11 a.m. Eastern. With that, I'll let you take it away, Michael.
Thank you, Emily. Thank you, everybody, for joining us. We trade tomorrow. I'll go over the trades results from last week. Nice week. Given the potential for tumult in the market, it was a nice week when you think about it for the week in general, but it was a good week for us too. And I want to wrap up discussing fundamentals of stocks. I've noticed that there have been huge capital inflows into the market in the last few weeks, which is pushing stocks up. And I notice there's a bunch of new members. I don't really discuss tactics or anything. Please use the training materials when you have time. I've been getting an increasing number of emails that I answer, of course, which show some of you don't know the difference between a put and a call. And some of you haven't grasped that, this is a cash and income focused service. Don't worry about portfolio value on a given Friday afternoon at 4. We closed one trade, a Roku trade. Very nice rate of return in a very short period of time of 0.8%. Depending upon how many contracts you sold, it could be a very lucrative trade, but that's a very, very powerful return for a very short period of time. Here's everything that would happen. Last week, there was Roku, which we closed. We rolled General Motors and Pfizer, and at the end of the week, we put on a StarBUX trade, which is what I'm going to be discussing at length in a couple of minutes to illustrate fundamentals and how you take your venti latte, which costs you $6, and translate it into trading a stock by selling an option that expires in a week. But you can see the rates of return here are quite elevated. We sold things that were either 1 week or 2 weeks out. We captured the volatility when we rolled Pfizer because there was earnings. We captured the volatility in General Motors because it was earnings. This is what you do when you are looking at the fundamentals of companies in the real world, which can be elusive, by the way. And I found a quote this weekend listening to a British murder mystery, which I'll read to you in a moment. But you can see these are really, really nice rates of return. And you can see the target's 26. The threshold level for putting it, even considering doing a trade, is 32. That's not the reason that we came out with 33, but that's the numbers we work with. 26 minimum, which is 0.5% a week. And now we're going to look at a potential trade. And sometimes if you look at potential rates of return, if you use the calculators, it may say it's less than 32, but that's because I plan to close it early. So the new trades had a very nice rate of return. But let's get to the week itself. Now, you can see on the left-hand column, Apple, Alphabet, and Amazon missed. Meta didn't have a disaster, so it actually missed. And revenue went down. It's a revenue-driven company. But the big pop in the stock, in my humble opinion, was a massive short squeeze. And let's look at the Fed spoke, and the market missed the point of what the Fed said. And Apple missed, it went up. No surprise with the miss. I just got an email that I answered about it. The whisper estimate for Apple was much closer than the average analyst estimates, which I'm going to show you in a few minutes, that you can find, let's say, on Yahoo Finance. Alphabet missed, and there was a concern about the nature of the advertising drop-off, but it wasn't a huge miss compared to real expectations, not anything published. Amazon missed, although revenue was very healthy in double digits. It missed on cloud services, which is a profit driver, and there was very little profit in the company. And the Fed spoke, quarter-point interest rate, not a lot of change in the language. Now, before I segue to the other half of this, the quote that I heard this weekend, and this is an admonition, firm voice, pedagogical, pedantic, didactic, whatever you want to call it. Here's the quote. If you look at red flags through rose-colored glasses, those flags just look like flags. Let me repeat that. If you look at red flags, left-hand column, through rose-colored glasses, those flags just look like flags. And that's what I want to discuss on the right-hand side of this. The mega techs, Apple's a hardware tech company, Alphabet's a media company, Amazon's a retailer, Meta's a media company that use technology. The market held up because of huge capital inflows. The other reason, by the way, Meta went up was a gigantic stock buyback program. When you look at the rise in the S&P over the last dozen years, but also a sharp rise during after the tax cuts from the previous administration and stock buybacks, et cetera. There's a lot of market internals as opposed to the real world that drove the market up. But I want to say the year of efficiency means that you may have to take your rose-colored glasses off and say efficiency means maybe more profits, which means valuations may be solid or fair, and therefore the whole market. I have to talk about the market in a slide because it's important to what we do maybe going up. But look at the last bullet point. The Fed's 1/4 point rate increase lifted the market. The market got it wrong. The bond market is pricing in a cut in interest rates at the end of the year. And folks, I watch people who watch the Fed, but there's a common sense here about the position of the Fed in the world and the signals it sells to other central bankers. And of course, the employment report on Friday, which was over 500,000. But the market got it wrong. Ain't cutting this year. And the question is, will this be a drag on the market as more and more people in the bond market go, oh, they're not cutting this year, which will spill over into equities? And does that put a lid or a slight reawakening of a bearish tint in the market? Or will it be a sudden realization next Fed meeting next month, et cetera, that, oh gosh, golly gee, we have it wrong, and then it could be sharp, which is an endorsement of our approach. Look to the real world and trade short term. So disappointing results. I'll read my quote one more time. If you look at red flags through rose-colored glasses, and that is what the stock market is doing, those flags just look like flags. Now, does that mean we don't trade? No, of course not. We're going to make a lot of money. And we're going to make a lot of money because we do stock fundamentals. Previous 2 updates, you haven't watched them, please go to the website. They're there. Many of you want the certainty of math. Isn't that cool? You know, you got a formula. The formula works, you make money, you don't have to think. Formula doesn't work, you fire guys like me and you try to find another formula. That's not what I do. And that's not what you should be doing. Formulas are all based on certain internal dynamics of the market that are inscrutable to the person who's selling you or giving you the formula, because that's what makes them the guru. What I'm doing here is giving you a light touch on how you can do this without me, and there's a much heavier touch. We're going to be doing this in Las Vegas. But the magic formula you're looking for, which doesn't exist, is stock fundamentals and the valuation of stocks, which justify you're willing to sell a put, which means you're willing to own the shares. Varies by sector. They can vary within a sector, and they can change. And that means you got to do your work. So I want to focus on Starbucks, trade from last Friday. But more, you should all be familiar with Starbucks. I mean, even if you don't drink coffee. And I've taken everything from a free source, Yahoo Finance. They may want your email address. I don't even know if they want that. So let's take a look at big market cap. The beta means it's volatility relative to the market. Guess what? It's pretty low. The PE ratio is elevated, but it's not elevated if you go back 3 years and take a look, because there are write-offs and there are different things that go on. And the earnings per share estimate is $3 going forward, which I think is low. We'll go through the chart in a minute. Next earnings are May. Previous earnings were good. Very low dividend. Ex-dividend date is this week. And the target estimate, that's a consensus, is $108, which would be a 5% increase. Pretty low for a major important brand. How does Starbucks compare to other people, to coffee purveyors and other fast food companies? Because I said you got to look in the sector. It's irrelevant. It's possibly relevant. You saw that beta, that 0.91. It's not very volatile. But it does have high premiums, which is why we traded. To the S&P 500. What is relevant is comparing Starbucks to core major important brands that do have above average growth. It's extremely exposed for day traders and whatever to other companies exposed to China, such as Apple, where Apple's China sales are material, but not very important, but the stock will move based on comments or sales data from China, and to historical norms for the stock, which are very easy. And if you do your own homework and you decide you're going to trade Starbucks for years, then you just keep notes and your own observations about things around earnings, around company announcements. Here's again, this is a screen capture from Yahoo Finance, and you can take a look at the revenues. So of course you had the downturn in 2020 because of the pandemic, but then the bump back, you're up almost 10%, 26.5, 29. You're up about 8.5 to 9% over 2019, and you can see the big bump. That's a big bump. You're looking at 32, 5.5. You're looking at almost 20% increase in sales from pre-pandemic levels. Now, why did this happen? That's my job, but you can go roaming around. Increased prices, more people getting back to routine, and there's a comfort in routine. And you know, I studied demographics and stuff like that, and so forth and so on. So now you have to take a look at net operating income, and you can see that operating income is also up about 10% from 2019, and that's the key. That's the key number down here. So here you have a lot more income because they hadn't fully staffed back yet, but people were still driving through and so forth and so on. You can see the big hit here during the pandemic. This is the number. It's up $500 million, or roughly 12% in a 3-year period. It's really good because they're reconfiguring their stores. They're closing shops, opening up more than they're closing. They're adding drive-throughs or building stores only with drive-throughs. And they have some stores which really pick up. They're very, very aggressive. So if you take a look at quarterly, you can see again, you have the dip here, and that's winter. This is winter. It's not unusual. And you can see as we accelerate, we go, and more people going back to work. And this is gift cards also. Although that it depends on how they do the accounting. Sometimes gift cards are counted here, but they're usually used pretty quickly. So a Christmas gift card for Starbucks may be used the following week. So if you go through this, it's the operating income again, which is what's really important. And you can see they're here. So they're done with the pandemic in terms of their income. It's a smaller percentage because revenue is up. So revenue is up slightly here. It's up about 5%. Their operating income is the same. That's pretty dang good when you think of the cost of labor. And they always paid more than other outfits. And if you were there a long time, they subsidized health insurance, and the price of coffee has gone down because of the strength of the dollar. So this 5% is a really good number. Okay. But let me step back. I'm not expecting you to necessarily do this, but what I'm trying to show is that public free information can give you a handle on how the company is translating its real world, what Warren Buffett calls a moat, the power of its brand, into financial performance. So what do analysts think? This is also in Yahoo Finance. You go onto the opinions link, 26 analysts, very healthy. And you can see there's not a gigantic, maybe I'd say about a 15% variation between low and high, which is quite small, but it reflects the beta in the stock. It reflects that it's a core retail brand. And you can see where average EPS is 409. That's a big move. That's about a 20% jump in terms of expectations. And this is a downgrade because of their construction. They're catching up with wages and prices. And over here is the quarterlies. These were, excuse me. These are the EPS estimates. This is the revenue estimates. And you can see this is sales growth, which is why I love the stock. I love the company. I think of a mature brand with a $125 billion market cap. I'd like you to name, other than Megatech, I'd like you to name companies in the real world that you walk in, or they touch you in some physical way, that have more than 10% growth, are projected out to have 10% growth, but are still a dominant, gigantic 20, 30,000 outlet, $125 billion market cap company. It's rare. It's very, very rare. Big box stores, a couple of retailers. So this is the key number, and this has to hold up with operating margins for people to be happy. And you can see the range here. It's very sophisticated. 22 analysts provide. So you can see it's a very narrow range, maybe 10% of the low and the high estimate, which means it's a stable stock. So what I want to do is give you a helping hand here in how to frame this in your head before you would trade it. And so you're saying it's lower, it's 0.91, very low ranges in the analysts, 15% on earnings and 10% on revenue, but volatility is high. Not the volatility is high, premiums are solid to high. Well, let's take a look at what people, which is individuals, people on Wall Street use proprietary Bloomberg data. They don't go to Yahoo Finance. So what are the companies that are most clicked on when someone clicks on Starbucks? Nike, big moat, big retail brand. Costco, best managed big box store, and there aren't many big box stores left, consumer focus. Disney, multi-channel, purely dependent on the consumer. Visa, dependent on consumer transactions. Walmart, dependent on consumer transactions. Dominant brands, duopoly, basically with Target, much bigger, and with Sam's Club, a duopoly with Costco. Visa, duopoly with MasterCard. Disney, no real competition on the streaming business. A tripopoly with Amazon Prime and Netflix. And with Nike, they're the 800-pound gorilla in advanced athletic footwear. It doesn't mean they have 80% market share, but they're by far and away the most important brand, not the hottest brand or the sexiest brand, but the most important brand in athletic gear, even compared to companies that don't do shoes. This is telling you that Starbucks is considered a consumer holding company, a core holding as a consumer stock and relating to consumer spending. Okay, so let's go back here. Revenue growth for a consumer core holding stock, everybody expects it to be in double digits. That's really important. So even a conservatively analyzed stock, people are saying 10% plus, and yet it's a core stable holding. It's a dream combination for us banging away every week or two because of the premiums. So I do see Starbucks as a core consumer discretionary stock in 2023. I do believe those numbers are important. That's why I focused on discussing revenue. And Wall Street's willing to accept that they're going to continue to manage labor cost margins and construction expenses. The company's exposure to China, of course, China's opening up now. You're going to see full results of an opening up by this quarter. But the question is the nationalist rhetoric when the sword rattling and balloon shooting and the Taiwan Straits stuff goes on. A certain percentage of the Chinese population shies away from American brands. But probably, this is a guess on my part, I couldn't find any information on it. Does it relate to Starbucks? And I'm guessing marginally no, because of the nature of Starbucks being urban and more worldlier people and younger. So I don't think that tensions, which may affect the purchase of Apple versus Android, although that's a Google phone, versus Samsung, I don't think that the China-US tensions, which are certainly going to escalate for the rest of the next couple of years, will affect the company. But that's an informed estimate as opposed to a lock. And at the end of the day, we have to say, how is it going to trade? It's going to trade with movements in consumer discretionary stocks and news from China, and it will trade better than the market with a bearish tint down. So if the market drifts down, it punches 4,000, goes down to 38.50 or whatever, Starbucks decline should be lower between what we saw in the number for volatility and that there's more specific drivers of the stock that are positive upsides, which is consumer spending clearly is going to hold up with all the people added to the labor force, and it's clearly going to hold up with credit lines are still liquid, and it's clearly going to hold up because China's opening up. So what did we do? We traded it on Friday. And there was a brief explanation. You can always email if you want a longer one. Global same-store sales, were up 5%. Average transaction spend was 7%. I think a few weeks ago when I recommended Starbucks, I think it was the Income Masters program, I was concerned about whether price increases would stick, because I remember being very unhappy after I rarely go there. I usually make my own coffee, and there's 2 good coffee shops near me where I can sit and work on my computer, but I do go to Starbucks probably about once a week. And I'm going, I just paid what for a cappuccino, medium-sized cappuccino with an extra shot? It got my attention. But it doesn't seem to affect business. And as you can see, um, we're talking about double-digit growth, and that's the predicate of my looking at the stock going forward. This was the trade, and so forth and so on. So now go back to the quote about looking at red flags, and you miss them if you have rose-colored glasses. I don't have we seen, you heard me speak, oh, I just love the brand and we have to own it. No. This was being hard-nosed and taking a look and going, a double-digit low beta core grower, big giant company with what Warren Buffett calls a moat, the power of its brand. It's a dream stock. Speaking of which, what stocks we'll be looking at this week? We're looking at consumer discretionary. The income numbers support that. But I wrote that actually last week. I thought that the income and labor market numbers would be good. I didn't realize it'd be that good. And life sciences and biopharma, which are harder to trade. There are fewer stocks in that universe for us to take a look at. Major earnings are mostly behind us, and the FOMC meeting is behind us. Then people start talking about March. And I want to reiterate what I said. The bond market has it wrong. The Fed is not easing this year. And the overhang to me on the structure and the trading and the technicals of the market is this going to be slowly priced in, or will it be a whoops moment sometime at the end of the second quarter or the beginning of the third? I've alluded to Investors Blueprint Live. It's February 27th to March 1st. A very, very expanded version in my 3 presentations on what you just saw. And we're going to start with a session on how we trade. Because you may say, no, you're supposed to start with stocks. No. You start with how we trade with an emphasis on goal setting and the tactics and the approach that you use. And the linchpin to what we just discussed here is, if I sell a put, am I willing to own the shares? And then the next session is an extended session where I'm going to discuss roughly a couple of dozen stocks, but 3 case studies of stocks I've never really discussed at length in any way or form, and how you find them. And they're going to be 2 universes of potential 10-unit bullpens that that have it's a different flavor for each one, depending on how aggressive you are. And then we're going to break up interactive. You're going to pick your own 10. Then the next day we'll get together, and all of you may want to trade 3 specific stocks. I have my 3, and my word will be the last word, and we'll be trading. So with that, let's go to Q&A.
Hey, Michael, Steve says Moderna and Merck.
Emily, I can't understand you.
He says Moderna and Merck jointly reported positive cancer trial results back in mid-December, and the Moderna stock price responded positively, but has since come back down. What are your thoughts about the cancer trial results and about Moderna's performance going forward?
The cancer trial was Moderna's a cancer vaccine that was used as an adjunct for melanoma with a Merck drug. And it revealed a couple of things that were very important next year, or maybe 2 years from now. This is a very smart strategy financially, because if it works as an adjunct, it's a messenger RNA technology is very, very extensible once you have proof of concept. Right now, it's just a COVID vaccine. For those of you who are familiar with Moderna, they started as a cancer treatment company. Read the book, The Shot That Saved the World. Fabulous book, and it's a couple of chapters on COVID vaccines. The rest is really about the development of Moderna and BioNTech's mRNA technology. But then they went to become a cancer vaccine company. But then, of course, they had the core technology when they needed a COVID vaccine. Fine. The proof of concept that this can be used as an adjunct with a proven cancer treatment drug is the only way they're probably going to be able to prove that the technology is extensible, and it will probably be a major business approach for this reason. In all treatments, you may hear about this in a clinical trial, that over the last 25 years, success in cancer treatment, believe it or not, has hit research very hard. And I think you deserve a long answer on this. I used to write a biotech letter, and been following this for a very long time. You have to provide, as a physician, the standard of care. And what it means is that more and more prospective cancer treatments are either slightly more efficacious than the current standard of care or similar. And those are hard to trial because you have to say, well, this is new. And it means that the people in the trial are sicker and have failed or have had mixed results from the standard of care. And so more and more drugs are being tried as an adjunct. Adjuvant, I think, is the technical term, because you can't change the standard of care. Now, advanced melanoma, there aren't really good treatments. Okay, medium stage, it's different. If Moderna pursues this and proves that the technology is extensible, it's a multi-billion-dollar market, and then Moderna adjunct becomes the preferred standard of care. And then someone would have to displace them, and the question would be how. The other thing is there will provide them clinical trial information about whether they can create a standalone cancer vaccine for, solid tumor cancers have very weak chemotherapy solutions. Kidney, liver, pancreas, there's not really. Lung has 23 different cancer cell types, and there's enormous amounts of research for matching a treatment that goes after a specific type of lung cancer. All of them are life extenders. None of them are remission creators. And so there's a strong possibility, and they have enormous research pipeline, that in addition to this approach, that they'll be trying to do solid organ tumors where there's very low standard of care. The problem is those are usually found too late. Okay, because there's no pain or discomfort or whatever. So it's a long answer, and here's the punchline. One proof of concept that this gets approved, and it probably couldn't be approved for another couple of years. The stock could go up tenfold. It may not. I may be totally and completely dead wrong, but it's a hugely profitable company, even with reduced COVID vaccines sales this year. And the bottom line is a gigantic pipeline. It might start acquiring companies with it. And the bottom line is one upside catalyst showing the technology is viable in the cancer market, and the stock could explode. Very long answer, but I think you deserved it.
Hey, Dave says, any thoughts on our Devon Energy trade? And Scott asks, will be rolling or accepting shares?
It depends upon the math. If we can roll out no more than 2 weeks and generate some cash, or roll to a lower strike price, and not spend any cash or spend a tiny amount of cash, we'll roll it. Otherwise, we'll accept shares and sell calls. And this is now a break-even trade. My goal is for us to either break even, lose 2 or 3% of the value, and then we're out. The China lockdowns ending boosted the entire fossil fuel segment. The heat up in the Ukraine war should have done the same, but the counterbalancing was extremely mild weather, independent of what's going on in New England. Extremely mild weather in Europe. I mean, strangely mild weather in Europe, and strangely mild weather in parts of the United States. So weather has overcome potential spikes in oil due to the war and Chinese coming back to the world with their economy. So we're going to target break even, and we should be able to, and it might take another couple of 3 or 4 weeks.
Hey, Keith says, in Options Income Blueprint, do you generally sell puts with stocks that are priced at less than $100 per share?
Generally, we went a little bit above in StarBucks. It was in shooting distance, spinning distance of 100. Yes, and it's unfortunate if you have a large portfolio, it means it limits the universe. But most of the people here who trade over $100 stock, anything more than one contract may be a difficult thing in terms of portfolio allocation. and diversification of your portfolio. And that's pretty much the reason. I mean, people in the income master's program, we do surveys, have significantly larger portfolios and than the average person or the median response to a survey here. And that's the reason. So it's not to keep the two services apart. It's just the profile of the typical / average member is quite different between the two.
Okay, I don't see any other questions at the moment.
Well, thank you all. If you're new, look at the other updates about fundamentals. Our Las Vegas event is really for you. It's not a moneymaker. It's something that we need to hear from you, and we want to introduce you to 2023 and how things are going to be going. And it's relaxing. It's a great time to meet your colleagues in trading. And I hope you get your mind around coming, because it's going to be fun. It's all fresh content. I think another question just popped up.
Yeah, that's related to a pricing issue. I just sent a
Sure.
question
Okay.
to Leslie, but no.
Okay. Well, thank you all, and I'll see you in live trading tomorrow.
All right, thanks, Michael. Thanks, everyone, for joining us. We have recorded this session. It will be sent to you today with your Options Income Weekly newsletter, which is sent in the evenings or late afternoon. We meet tomorrow for live trading. That's going to be at 11 a.m. Eastern. And we've already sent you your schedule for the full month. There's just one link to register for that. It's separate from today's registration link, though. So there's one registration for all of the trading sessions. As always, please keep an eye on your inbox for alerts, and we'll see you tomorrow at 11 a.m. Eastern.